One Roth conversion, one big sale, one good year. You worked hard for that success, but suddenly, your Medicare Part B premium jumps by $400 a month. That is an estimated $5,000 penalty for doing everything right. This isn't a mistake. It is called IRMAA, the Income-Related Monthly Adjustment Amount. Most people trigger it without ever knowing it exists. Now, look, I am not your financial advisor. I am simply analyzing public reports here. This video is for educational purposes based on official Social Security Administration, SSA, data. The stakes are high because you often won't see this coming until it is too late. But the worst part isn't the bill itself. It's how long the government waits to send it to you. To understand the danger, you have to understand how the SSA calculates these fees. This is not a sliding scale. IRMAA operates on what we call cliffs. If you are even $1 over the income threshold,
you can end up paying the full penalty for that entire bracket. There is no middle ground here. Think about that for a second. A single dollar, the price of a candy bar, could potentially trigger an extra $4,000 or more in annual surcharges. It is incredibly frustrating to be punished so heavily for such a tiny margin. But it gets worse. These surcharges apply to both Medicare Part B and your Part D prescription drug coverage. You saved, you invested, and you had a successful year. Therefore, you may now find yourself owing a debt you never signed up for. So, why didn't you see this coming when you filed your taxes? The reason this catches so many people off guard is the timeline. The SSA does not look at your current bank account. They look at your past. Here is exactly how it works. They use a 2-year look-back rule. Your income from 2024 is what determines your Medicare premiums for 2026. You might feel safe today,
but the trap was already set 2 years ago. And it is not just your salary that counts. They look at your modified adjusted gross income, MAGI. This includes your capital gains from selling a home and even tax-exempt interest from municipal bonds. Most people think municipal bonds are safe from the government, but for Medicare, the data shows they are not. Every dollar of that tax-free interest is added back to your total, potentially pushing you right over that cliff. Take a breath. I know this is complex. The math is fixed, and you cannot change the past. But there are ways to prepare for what may be coming next. However, you need to know exactly which moves are the trigger wires. Now, we need to talk about the most common trigger for this surcharge. It is the move many experts tell you is smart for your retirement. I am talking about the Roth IRA conversion. Converting money from a traditional account to a Roth increases your income for that year.
it feels like a win because you are locking in tax-free growth. But for Medicare, it can be a disaster. For example, in some cases, a $50,000 conversion could trigger $5,000 in extra fees. You are essentially trading a future tax benefit for a massive bill right now. And remember, this is a double hit. The surcharge applies to both Part B and your Part D drug plan. The SSA will not call you to warn you about this. They simply wait for the IRS to share your data and then they send the bill. But what if your income in 2026 is much lower than it was in 2024? Take John, for example. He sells his family home to downsize for retirement. He makes a great profit, but it exceeds the IRS exclusion limits. John suddenly finds himself in a higher Medicare bracket. He didn't lose money on the house, but he is now losing hundreds of dollars every month to a surcharge he never expected. Then there is Mary.
She wants to be proactive, so she performs a massive Roth IRA conversion to lower her future tax bill. She is following standard advice, but that move pushes her right over the IRMAA cliff. Mary is now paying for her future tax savings with a massive check to Medicare today. It is not your fault for not knowing these rules. They are designed to be invisible until the bill arrives in your mailbox. It can feel overwhelming, but the rules do allow for specific adjustments. The government actually provides an escape hatch. If your income in 2026 has dropped because of a major life change, you may not have to pay the surcharge based on your 2024 tax return. You have a legal right to request a review using the Form SSA-44. Many people choose to consult with a tax professional before filing these forms to ensure they meet the specific criteria. Generally, qualifying life-changing events include things like marriage, divorce, or most commonly, work stoppage or work reduction. If you retired recently, you can ask the SSA to ignore that old high-income year and look at your current situation instead. Here are some steps people often take. First, check your 2024 MAGI against the 2026 IRMAA brackets. Second, identify if you have had a qualifying life event. Third, some retirees download and review Form SSA-44 from the official website. And looking ahead, some retirees consider spreading Roth conversions over several years to try and stay safely under those cliffs. IRMAA is a hurdle, but with the right form and a bit of timing, it does not have to be a permanent roadblock for your retirement. If this breakdown helped you understand your healthcare costs, consider subscribing for more Medicare math.